All right, well, let's jump into things. So the topic for today's talk was angel investing today. Yeah, I guess the big thing to talk about when we're talking about angel investing is it's a kind of investing, and it's probably worth stepping back for a second, just thinking about the world that we are sitting in today. And this is a world which many of us are really not used to, which is a world of reasonably high inflation. And well, reasonably high, it just hit 9% inflation and price inflation in the US. So we're talking about something where for many of us, we've spent a decade or more of inflation of sub 3%. And now we're talking of inflation, which, yes, it's going very high right now. Many people believe it will come down, but we're still talking about a potential world where you've got inflation of on the order of 5%. And if it does stay in that way, and we're always slow as human beings to adjust. I mean, I don't know for sure where inflation's going. Many people say it's going to come down again. It'll come down again. The US 10-year bond fund has got a 3% return, which again makes you think that inflation should come down, or it could be that it's lagging. But imagine for a second that there's at least a possibility that you need to start investing in a world where you need to get over 5% returns on your money just to stay level, to not lose wealth. And this is a very different world than the one we're used to. So when you think about investing in this world, look, there's a couple of basics, first of all, which is one of the things to start thinking about is to start thinking about angel and VC investing, and just a couple of ground level things to cover off for you. Many people invest in the stock market, and look, the stock market tends to be a great hedge against inflation. In periods of rising inflation, you tend to be better off in stocks and worse off in bonds, as a very general rule. And I'm the last person to tell you to time the market, and there are people who are far smarter than I am on this. What I know a little bit about is I do know a little bit about private companies, and what many people don't know about private companies, they spend all their time thinking about how do we optimize our stock market investing here. If you look at the total sales, the percentage of total sales generated, for instance, in the US economy, which has got a very strong public equity market, you see that over half of all sales are generated by private companies. So if you are thinking about how to invest, you do need to think about what is your strategy for investing in private companies. And this is especially true if you think about investing in tech companies. And just sort of quick history for those of you who don't know, if you invested in companies like Microsoft or Amazon, when they first listed in the public markets, you could have made a lot of money. So you could have made over 2,000 times your money back. And these were great investments to make when they listed. The thing is, in the past 20 years, companies take longer and longer and longer to go public. And you've seen like Google, you would have made 40 times your money. Facebook, you'd only make 7 times your money. And this, remember, is if you pick the biggest winner, because there's lots of tech companies which won't do so well. So really, if you're a retail private market, a retail public stock investor, you have no chance to take part in the sort of the mega growth of successful tech companies unless you are an angel to get into the very earliest stages of some of these, of VC or in private equity. Now, SPACs were a big movement in the sort of the past 5 years to really try to bring some of these companies, give people access again, take some of these private equity venture capital companies and list them earlier so the public investors could access them. SPACs have really blown up, and in many ways it's not surprising because SPACs are very well designed. It's a great thing to be the promoter of a SPAC. You get a great return as a promoter of a SPAC, but honestly, they haven't necessarily been designed to give good returns to individual investors. So many of you are probably saying, well, why on earth would I want to invest in stocks right now, and especially in tech stocks? 2022 has been a really bad year for tech stocks. And if you look at it, forward multiple revenues have, well, valuations have come down. If you look at forward revenue multiples, just basically the valuation of the company divided by the 1-year forward revenue, you can see that these numbers have gone from sort of a median of over 10x down to a median of around 5x in the past year. And look, as far as we're concerned, that's a really good thing, because we found that valuations have been very inflated in the past couple of years, and that it's actually really reassuring to see things coming down back to normal, and that people are sort of, I would say that the market is priced more rationally. The thing to remember about this also is to not get hung up on what is going on in the public market for large late stage public software companies. VC is really, first of all, it's a business about home runs. You're looking for a few companies to increase a lot in value over 5 to 7 years. So even if their market is coming down, they will be growing so quickly relative to their market that they can still make a lot of money. The second thing to sort of be aware of here, with these multiples go up, multiples go down. It's not a big thing overall, and it's an interesting time in the markets, but it's still going to be a very there's still a lot of chance to make money with angel. There's another thing here, just to remind you that we've been here before. So this is a chart which shows the within venture capital, there's sort of a fundraising index in purple here. There is the capital raised per company in blue, and we'll just hit a couple of things here, just focusing on those two things. First of all, you can see that the median capital per company had some significant dips in 2003 and the 2011 period, but it's sort of hit a fairly steady-ish point right now. It's been continuing. It's going to be interesting to see what happens in the near-term future. One of the things that we have noticed is talking to early stage venture people. Early stage venture does not seem to be affected yet. People who are early stage investors tend to say they are investing as much or more. Where you see an investment pullback right now is by later stage venture investors. So it'll be interesting to see. I mean, I don't have a crystal ball, I can't forecast the future, but it's been interesting to see. It'll be interesting to see how these lines react. But the bottom line is, we've had dips before. We've had the dot-com crash. We've seen a lot of things occur here. And what we're living through right now is not necessarily any different than that. And it is worth mentioning that fundraising collapsed post-dot-com in the sort of the 2011 to 2013 period. Yeah, it came down a bit, but it didn't actually come down a massive amount. And you've also got your median net IRR by vintage year. This is a lagging indicator. This shows how funds did based on the year they were incorporated. And you can see that there were flattish for venture funds who were in the sort of dot-com, sort of post-dot-com bust era, and that was steadily building up. I would expect to see these returns start to come down for funds who are more in the 2018 to 2020 vintages, because the returns have been so exceptionally high. But don't know for sure, but you can certainly expect as valuations come down. I mean, VC angel is a very simple business. You buy low, you sell high. And as long as you're buying low and selling high, now is a great time to buy low. Another thing when you think about this, and people don't always think about how long it takes when you're investing to get your money back. So when you are making angel or venture investments today, you are investing, you are going to get that money back typically 7, 10, 12 years in the future. So you're taking a bet today on what the market is going to look like a decade from now. And it's buy low, sell high. Your selling is going to happen in a decade. So whether the market is up or down today sort of doesn't matter to you. It matters where it's going to be. This is the exact time, how many years it takes companies on average to exit. Typically 7 years to get a 50% of the M&A happening, 8.5 years to get 50% of the IPOs, 12 years for 90% of the IPOs. Look, I've been angel investing, I angel invested for about a 15-year period, and you can see my best returning investment, which took me it gave me 30 times my money back, also took 14 years to exit. In fact, I was just sitting with an entrepreneur in New York 2 days ago who told me that his company took him 18 years to exit. So one thing to remember when you're investing in this market is your money will take a long time to get back to you. But the good news, it's going to be based on what the market looks like 10, 12, 14, 18 years out. Also be aware it takes things a fairly long time to fail. 3 years for on average for half year failures and about 6 years for things to get clear. Failure is actually okay. And by the way, if we are in a market now where it certainly looks like larger later stage VCs are cutting back on their funding a bit to react to the public markets, as they should, that may result in an acceleration of failures for some companies. So some companies may take a little, the time to fail may be a little shorter because money may be less available than you thought, but this is actually a good thing. In this industry, you should expect investments to fail. If you're an angel investor, embrace failure. Failure is good. It's going to happen in your portfolio. And in fact, we've got data points here from Correlation Ventures over a multi-year period in the US where they tracked over 21,000 financings to see how the deals did. 65% of those deals failed, and you cover your losses from another 31% of the deals, and then you make all your profit from 4% of the deals. And here's the exact math here. It's sort of 65% give you about 0.1 back, 31% give you around 3 back. And you can see just this first 96% of your deals, you make your money back, and then you typically double your money with the remaining few deals. So whether a few deals more or less fail here, what really matters is the successes, which are where you make a bulk of your money, and they take a relatively long time to give you that money back. So I haven't spent a lot of time introducing myself. Let me step back and do that for a second. So I'm Kamal Hassan. I'm one of the managing partners along with Michael Kosick of Loyal VC. I've been an entrepreneur, at least 5 different companies over a 20-year period, been angel investing, spent about 15 years as an angel investor. I'm no longer an active angel investor because I'm running a fund and all my efforts go into the fund itself, Loyal VC. I'm a former Bain & Company consultant. I spent time with the Founder Institute Accelerator. It was really interesting because I started off, I'd been a successful entrepreneur. I did my undergrad in engineering physics. I was top of my class at NC. I had a Bain & Company consultant. I sort of walked in thinking, you know, I really understand this angel investing game. And just to share a little bit of my personal experiences, I knew what the stats were. I mean, the 65% failure, et cetera. It's like, wow, but yeah, I'm different because I've been an entrepreneur. I've been a management consultant. I know what's going on. And I very quickly learned humility. And my personal stats, 7 of my first 10 deals failed completely. 2 investments gave me between 1 to 2 times my money back. But then I had that one big investment, the 30 times home run 14 years later, which meant overall my portfolio gave me 4.6 times my money back. I looked like a really smart investor, but I really deeply learned that I was no better than the average and trying to think that I was the exception and I could pick winners in a way that everyone else didn't. Quickly learned that wasn't really the case. And I'm not the only person to learn this. There's BESSEMER Ventures. They are probably the oldest venture capital fund in the US. It's the Rockefeller family. And on their website, they have their anti-portfolio. And anyone who's investing, I recommend you go to BESSEMER, just Google BESSEMER anti-portfolio and read it, because they tell you a number of the companies they passed on and why. Google, Apple, Zoom, Tesla, Coinbase, Facebook, PayPal. And often the logic was really good. I mean, when they looked at Facebook, they put their logic right in there. And the partner from Bessemer who heard the pitch for Facebook said, look, kid, have you never heard of Friendster? Move on, it's over. And he was absolutely right. There was this up there on the East Coast doing what had already was being done successfully by a Silicon Valley company. It sounded and looked like it was exactly the same thing. And most VCs don't have the time or the crystal ball to look more deeply and say, no, but this Me Too is actually going to do far, far better than Friendster. And this really leads us to a question about what kind of activity is angel investing. And if you're thinking of doing this, really the question to start to ask yourself, is this more like cooking where there's a recipe, you start with a predictable recipe and you get a predictable outcome? Or is this more like something like playing poker where you can start off and be dealt a pair of aces And a bunch of times that pair of aces is the best hand, it's the best possible starting hand you can be dealt in poker. Yet depending on which cards get turned up later, you can end up having in fact, 3 aces, which lose to a hand which has got 5 hearts, or a 3, 4, 5, 6, 7 in a row. So really, through my personal experience, have come to really deeply believe that angel investing is a lot more like poker, that it is unpredictable, that you can bend your odds one way or the other, but you don't really know how things are going to turn out until the very end. But thinking like this is going to very much affect how you invest. And one of the things to think about is, if you can't predictably say this one company here is the one that's going to succeed, if you're going to be like a Bessemer Ventures, who's going to get the Facebook, the Google, the Apple that they're going to say no to if they're only picking a few companies, one thing to think about doing is to really think about diversifying, investing in more companies. And really, one of the reasons that you want to diversify, and there's an argument which is being made by some people in the industry, that you should invest in every credible deal that comes your way. Now, you shouldn't be investing in the deals which are almost certain to fail, but something which is credible, which has even a small chance of success, you should look at very closely. And the reason you do this is funding everything credible reduces the number of times you miss out on these very rare mega winners. If you miss out on the Google in your portfolio, and you want to think about what you're missing out on, not just the things you're making, then that has a very large impact on your probabilities of success. So make sure you're a highly diversified investor, and that's going to give you more chances to have these big home runs. And it is those big home runs. Look, if you only 4% of deals are these big home runs, if you only make 10 investments, like I did, by the way, the odds are that you'll be unlucky and you won't get a home run in there. You really need, you could say 25 deals, but even if you do 25 deals, there's still about a 40% chance you won't have a home run in there. And you really need to get about 50 deals before you predictably have home runs. So think very much, if you're investing here, about diversification, about getting a large number of investments, if you believe that this is an unpredictable activity. And by the way, if you talk to VCs in Silicon Valley, 90% of them will tell you, no, no, no. They have a secret why they can predict who the winners are. They know their industry. They know everything else. Remember, these outcomes are the outcomes obtained by US venture capitalists who all believe that they can pick winners. Every time a VC does a deal, they are convinced, they've had a whole investment committee who they've convinced that this is a home run. And yet 96% of the time they're wrong. So there's a whole industry of people who think they can predict who's going to win. And with experience, with track record, with all sorts of credibility with investors, this is how they perform, with 96% of their home run swings missing. So if that's how they perform, unless you think you're smarter than almost every other VC out there, maybe it's this type of activity which is unpredictable, and you should invest that way. If you actually take that distribution I just showed you and do a Monte Carlo simulation, which says, what would a portfolio of 10 investments look like the classic 10 investments I started with, which a number of VCs do. It's really interesting that when you compare that to the real values obtained by Cambridge Associates, if they say what the global VC fund returns are, there's a really good match between a Monte Carlo model with this data and the real returns of VC. And the reason I do this is to say, what happens when you diversify, say, to a portfolio of 150 companies? And a couple of interesting things happen. First, your median return goes up. Secondly, unsurprisingly, the variance goes way down. If you take a random selection of companies, you'll get a very low sort of spread on those returns. But what's really interesting here is if you compare this to public market returns, you also have returns which are the median is above public markets. And returning to the initial comments about inflation, I mean, today we're running at a 9% inflation rate, and certainly I think we all hope it won't stay there. But you really, if you're really starting to look for returns, this is yet again something to consider about if you want to beat inflation. You probably will beat inflation over the long term with public markets, but it's a good time to think about angel and venture. And this, by the way, just shows you the returns over time. I showed you this graph another way, but you can see the returns by venture capital vintage. You can see that they go up and down over time. Now, you could certainly argue recent vintages probably will have lower returns, and the upcoming vintages, people who are investing this year, next year, will probably see higher returns as the market comes down. But honestly, if you don't know for sure, if you don't want to time the market, just diversify by time. And we've got an open-ended fund. We diversify by time. So the best thing to do if you want to be disciplined about your investing, if you're going to be an angel, make a few investments this year, make a few investments next year, plot out to invest over multiple years. I'm talking about diversification. I want to take a little sort of side tangent for a second when talking about diversification. Many of you may not, when you think about diversification, you think about countries, you think about industries. Many of you may not think about diversity in the types of entrepreneurs you're funding, but there's a really interesting behavior right now in our industry, which only 3% of VC dollars go to companies with a woman CEO. And in fact, there's a similar study out of BCG, which says, guess what? Women-funded companies give 2.5 times more dollars of revenue per dollar of funding, which is a sort of very interesting. You could start off and say, are women better? I tend to sort of take the argument that women are massively underfunded. So the women who do get funded, it's the best women getting funded. So of course, they're going to outperform the average men who are being funded instead. Now, people have really, in the past decade, focused on, they've noticed this number and they focused on increasing the number of VC decision makers. And this is growing now, depending on the stats you look at, it's sort of 16%-ish in the US right now. And the view has been, well, having more women means more women will get funded because women are going to fund women. The actual truth is this 3% has been flat, and this 16% has been growing. So hiring more women hasn't necessarily addressed it. And there's this great study out of Harvard, which says why. This study out of Harvard took an identical pitch. They had it voiced by male and female actors, first with a voice recorded, then showing you pictures of who that person was. So it's just a picture of the person with the same voice. And the identical pitch, they had it sort of scored about whether you think this is a good investment or not, scored by audiences of both male and female listeners. And it didn't matter who was listening, whether it was a man or whether it was a woman, the scores came out like this. And you can see there's a dramatic difference. The same pitch was scored a 5.2 if done by a good-looking man, a 4.6 when done by a less attractive man, and scored by women a 4.35, a 4.14, you can see. So it was really a dramatic difference. And the big takeaway which we have from this as a fund is we say, look, pitches, we know that human beings are biased based on looks and gender when you're listening to a pitch. So the big thing to do, ditch the pitch. Try to find other ways to invest other than listening to the pitch. Big sort of part of this is don't listen to promises, really look at what people do. And that's probably worth spending 2 minutes. We share some of the secrets of the fund ourselves. We run, what we do is we run a venture fund, which has been running for 4 years with very good returns. We have a staged investing process, which we use to drive returns, where we make small investments first. Well, I'll tell you more about the staged investing first. The second thing we do is we're massively diversified to protect capital. The third thing we have is an open-ended fund, which I'll explain in a second. But you can see we run a massively diversified fund because we believe in this, make a whole bunch of investments. We've made over 250 of them right now. And this way you will be sort of protected no matter what goes on in the world, no matter how the world develops. You should have some sort of coverage in what you do. We also don't diversify by sector. Our largest sector is 11%, but we have something like 8 sectors here, which make up at least 6% or more of the portfolio. So it's massively diversified, whether it's media, ag tech, blockchain, health, fintech. There's a bit of everything in the fund we run. And we take that diversified group of companies and we then invest in this manner, where every company starts off with a small pilot. We do some focus here to try to make sure we have a diversified number of pilots, and we then focus the funding into the top performers. And we give people more money based on how they perform, not what they do. In fact, even the pilots, we don't take in companies based on pitches. We never listen to pitches. We work with partner groups who spend time vetting companies for us, such as the Founder Institute Accelerator, and they help us sort of do the screening to give us plausible companies, and then we simply fund the best of those based on months of evaluation and see what they do. And really the reason we do this is these initial investments of that 10,000, then a 200,000, give us a base of quite a diversified portfolio, and then we keep funding typically after it takes a year to move from each stage to the next. And by the time you get to these $1 million investments, which actually take up over half of our portfolio, we're really focusing money into the winners to drive returns, because diversification will give you venture capital average something around 12% returns in the long term on average. But if you want to exceed that, and our fund does exceed that, it's been above 20%, it happens because we focus funding into those winners. Now, a lot of people, when they hear this, say, okay, well, that sounds like a very simple strategy. Great, I'm going to just give money to the best companies. One thing to really think about is you will find as you start angel investing, and in fact, you'll find as you start looking to invest in VCs, that the question, and here's a quote from The Economist last year, that the question for VCs in Silicon Valley is less what startup to back and more whether a startup lets you invest. We have portfolio companies where their sales are increasing by 1,000% a year. It's not rocket science to say, wow, this company is just growing like gangbusters, give them more money. It's actually a challenge in the best companies to get your money in. And that's really what this industry looks like. There's companies at an early stage that nobody wants to fund them, nobody wants to fund them, they're fighting for every penny of funding, and then they suddenly start to take off. And all of a sudden, everybody wants to fight them, and the entrepreneur has their pick and choice of who they want to fund them. Now, if you want to say, what do VCs look for when they're looking at who will fund them, there was a great survey done by the Kauffman Foundation, and they took a whole bunch of factors, and they asked VCs to rank the factors on which they thought matters the most to entrepreneurs. And the VCs said, you know, what matters to an entrepreneur is the relationship, the chemistry, the brand of the VC, and the deal terms. And then they turned around and asked the same question of founders. And founders said, yeah, we really care about what the person is, how to get along with them. And this is a good lesson for your own investing. The next thing they said is they really cared about deal terms. And by the way, Loyal VC does open, so we do common shares. Very happy to talk about that in the discussion if that's of interest. We'll move to the discussion in a couple of minutes. But deal terms, and we work very hard in giving deal terms, they said they didn't care at all about the brand of the VC or the partner. This is really good news for you. You can get in and be an angel investor, even with no name. You can still get your money taken if you are nice and people like working with you, if you offer good deal terms. And the third thing that the entrepreneur said mattered to them was investor speak. VCs didn't think that mattered at all, but actually it's crucial. And by the way, if you're ever part of an angel groups are very, very slow acting beasts. So you may want to sometimes attempt to take deals from that you see in the angel group and approach them directly. I know some top angels who do that, who they're part of an angel group to see deal flow, but they will also sit on the screening committee and they'll approach companies directly immediately to see if they can get money in quickly. So that is something to consider if you're trying to invest here. Think about what you need to do to get companies to say yes to you. Now, look, I've given you a lot of theory about why you make small investments, get to know the companies, follow on. Here's some of the actual math. So you can see we got about 11% return on our $10,000 investments and in excess of a 40% return on the follow-on investments. And oh, by the way, 98% of our offers are accepted. So we do a pretty good job of this because Entrepreneurs like working with us because we really focus on adding value. Now, of course, we have a network of over 600 advisors, which really helps. But this is actually a fairly simple formula for making money in early stage investing. Make small investments, work with the companies, build a relationship, get to know them. And when they succeed, try to get your money in and try to have added enough value they want to take your money. The last thing which our fund does, it's an open-ended fund. And I just wanted to return to this slide I showed earlier, which is how long it'll take you to get your money back. If you are an angel investor, remember your money could take as long as 14 years to come back, or even I mentioned the entrepreneur I just met, who by the way had an extremely profitable exit, who took 18 years to sell his company. So you have a very long time to exit. And one of the problems as an angel investor is, sure, if you're under 40 years old, it's a great time to get in. You don't mind. I did my angel investing, a lot of it when I started when I was under 40, and it was actually very straightforward because I knew that, great, it's going to take me to my 55 or even 60 to get the money. That's fine. I don't mind. Whereas if you're already 60, 65 years old, a 15-year horizon starts to become a fairly concerning horizon. And what we do with our fund, when we launched our fund, we said we'll make an open. And so, by the way, if you're going to invest in so if you're going to be an angel, you'll have a long tail and you'll have often the best deals, which take the longest to exit, where your money is going to take a long time to come back to you. So just be aware you're locking yourself in. Venture funds have the same problem, that their deals are locked in. So they will then typically have a 10-year fund extendable by 2 years or 2 and 2 or whatever it is. But your money, again, in a venture fund is locked away for sort of a 10-year period. Our fund is an open-ended fund. We set a price every quarter. Every quarter, you have the right to request a redemption. We don't guarantee the redemption will always be filled. To date, we've filled 100% of our redemptions, but you may only have a partial fill rate. It might take you a couple of quarters to exit. But the bottom line is you have the possibility to, 5 years in, say, look, the companies are doing well, I've made some money, I would like to spend that cash. I don't want to have it sitting there on my balance sheet locked away. And with our fund, that's why we did an open-ended fund. So let me stop there. I've covered a lot of different points, different things in terms of angel investing, things to be aware of, especially in today's environment. But let me just stop there and throw it open to everyone for any questions you may have. Now, we've got a fair number of people, so it's probably best to stick your hand up or to enter directly in the chat if you have a question or you want to ask a question. We'll be happy to take whatever questions you have. Good. Any questions at all?
Kamal, so I have been asked several times during the last few days that should we be investing in the comparatively later stage companies? So that's one question. And if yes, then which are the sectors that one should focus on?
So, look. Investing 101, when everybody else is not investing, is a great time to be investing. Now, it's very hard to time the market. I prefer to invest steadily over time just because I don't believe in my abilities to time the market well. You never know, as the market come to the bottom, is it on its way down? Is it about to turn around on its way up? I mean, we all, I'm sure many of you may remember the absolute panic which investors were in March of 2020 when COVID came around, and the markets just went into free fall. And because everyone was convinced that, hey, COVID was going to completely kill the markets. What happened thereafter? Big rally. Was that predictable? You know, probably not. We can try to give excuses for it now, but it wasn't really predictable behavior. At least for most of us, it wasn't predictable behavior. So sectors to invest in right now, really, honestly, I really don't know. It's been a very good period to invest in agriculture, for instance, recently with commodities going up in price, inflation. A lot of these types of things are very good. But it's been good investing in agriculture over the past few years. Will it be in the future? I don't know. Travel, it looked like a horrible time to invest in travel in the past 2 years, yet travel is just going gangbusters right now. It's sort of the summer of revenge travel people are talking about, and travel companies have been making money hand over fist right now. So this is the sorts of complexities you run into, is to say, yeah, you could have said travel was killed by COVID. That's a great time to invest in travel. It takes a lot of courage to do that. So I prefer to invest across sectors, to simply have a number of things out there in terms of sectoral coverage, such that whatever happens, you'll do well. So that's the way I think when I think about diversification. So
Hemi, yeah, Hemi is asking in the chat box, any comments on angel investing models, syndicates, or different angel funds?
Yeah, there's sort of two sides to this syndicates and angel funds question. There is a time question and there's a diversification question. Now, we've talked about diversification. If by taking part in an angel fund or a syndicate, venture fund, whatever it is, you can expose yourself to more companies, that diversification on average is good for you. So it's great to join a syndicate. It's great to join an angel fund where all of a sudden, if you're a syndicate member, you can put $5,000 into each investment rather than putting $50,000 into each investment as a direct investor. The flip side, of course, is this time period when you're trying to get a number of people to all invest together. It's a real challenge. You can then put money into a sort of pre-existing fund and have someone else manage that for you. That allows whoever's running the fund to move very quickly, so they close deals more quickly. But there are some angel funds where they sort of get deals, they bring it out to all the individual angels, all the individuals say, are you in or not? That slows the deal down. That results in making it harder to close the best deals, which often you need to decide on very quickly. One of the nice things about investing in syndicates today, and there's a specific use of the term syndicate on AngelList. So AngelList has what they call specifically AngelList syndicates. One of the nice things when you invest in a syndicate, your money goes into not just the deals done today, but any deal done from today forward, which again will give you some of that time diversification. Now, we're an open-ended fund. We offer that same sort of facility. But in general, I think these are good things. One of the challenges about angel investing is it's a lot of work, but it's really fun. So when somebody else invests your money for you, they're taking some of that fun away, though of course they're doing the work of the diligence. So in general, I think they're a good idea. They're good in some ways, perhaps not as good in others. Perfect. I've got a question here from Cassidy. He says, do you have any experience with angel funds business model? And I guess that was the point which I was mentioning earlier, is that there are different models for how you run an angel fund. So for instance, there's an angel group here in Toronto where all the angels get together, they throw money into a fund, and then that fund is run by the angel fund the administrators of that group run that angel fund, and then they will then make investments directly in the companies they think are the best ones. And it makes it a lot easier for the angels because, okay, the angel fund is screened, the angel fund says, this is a good company to invest in, I can piggyback on their due diligence, but I still get to pick which few of the deals you do that I like. So that angel fund is very successful. There's a number of other angel funds, which honestly are just venture funds. I mean, we run a venture fund, but you could easily call us an angel fund as well, because we do early stage investing, a number of, well, we're cross stage. We do some early stage, mid stage, late stage, but we are competing with angel funds because we'll be investing in companies at the same time as other angel funds will be doing so. But that's just a venture model, which is you give your money to somebody else to manage and to invest directly. And then again, that person may give you co-investment rights. We give you co-investment rights. They may or may not. And yeah, we've talked a little bit about the AngelList syndicates, which are sort of another model of angel funds. So yeah, there's experience with a few different ones. I actually spent some time trying to get an angel group together years ago when I was for INSEAD, my business school, because I saw back then that there were great INSEAD deals to be funded. And that's actually one of the partnerships Loyal VC has right now, is around half our deals come from alumni of the INSEAD Business School. Good. Are there any other questions? Yes, there's a hand been raised. Yes.
So Kamal, in the light of given the fact, and I remember you had another webinar where you discussed the trends, especially related to the open-ended venture capital funds.
Yes.
So in light of perhaps in the coming future, more and more VCs moving into that kind of space, we saw Sequoia doing that. Is it something that would perhaps change the landscape of angel investment funds, angel funds?
So yes, I think it's a growing trend. There's been about 200 or so open-ended venture funds have existed over the past 20 years, according to one study I saw. So it's less than 1% of all venture funds, but it's still a non-zero amount. I had a very interesting conversation with a McKinsey partner in wealth management out of the Middle East who said, look, open-ended funds are inevitable because they're so much better for the investors. And you can imagine as an investor to be told that, hey, give me your money and you can't touch it for 10 years. That's not a very attractive offer when every other investment you have, you can trade in and out of, but this one investment, your money is locked into the fund for 10 years. In fact, many funds, it's even worse, they have these things called capital calls, where not only is your money locked away for 10 years, but you have to keep the money in your own bank account, earning no returns for 2 years till the fund is ready to take it. Open-ended funds just make a whole lot of sense from the investor's point of view to have more power, more flexibility. And Nidhi, as you mentioned, actually Sequoia Capital, one of the biggest venture funds out there, moved to an open-ended fund model in October of last year. And we've been doing an open-ended fund for the past 4 years. I've met fund managers who have run open-ended funds for over a 30-year period. So there is knowledge in how to do this. It is a very sensible model. Look, according to this McKinsey partner, and he's paid a lot more than I am to figure these things out, he certainly believes that open-ended funds are the future and you will see more and more of them. But I just think like an investor, and from my point of view, why would I give my money to a fund to manage when I know how to do angel investing? I could invest directly, but the one thing a fund can do for me, which I can't do for myself, is it can give me that potential liquidity, the chance to say 3 years in, hey, I want to take some cash out of this section of my portfolio and spend it and use it. And we've had, I guess, 5 or 6 of our investors have done that so far. And they love the investment. They're often staying invested in our fund, but they take money out because they want to fund their business as an entrepreneur, because their crypto portfolio is collapsed and they actually need some cash from somewhere and they don't want to sell all their crypto, whatever it is. Murali, okay. You've got your hand up. Go ahead.
Yeah, hi Kamal, good to see you again. Hi Nidhi. So my question is, like, it's still a bit difficult for cross-border investments. So any updates on if has it been made easy to invest from India into other countries?
So yeah, so India, probably the sort of 2 or 3 most restrictive country. If you look at the 3 most restrictive countries in the world for investing, India and Brazil are 2 of the 3 countries on that list pretty well always. There's 2 types of challenges. We actually invest into India out of a Canadian fund. So there are restrictions on money coming in and you have to jump through a whole bunch of hoops with the RBI, Reserve Bank of India. But as far as I know, I have not yet heard, and Nidhi might know better, but I've not yet heard of any changes to the regulations. So I still think you get whatever it is it $100,000 or something that you can invest abroad each year? And yes, you get to choose whether you're going to invest that in Amazon, in public stocks, or in foreign private stocks. Certainly my advice would be, as someone who believes very highly in diversification, to say, yes, make sure you invest outside of India every penny you can, so that you've got a mixed Indian and non-Indian portfolio, because you want it, no matter what happens anywhere in the world, you want to be protected. And I would also advise that you have to do some of that public versus some private. But yes, you're going to be able to buy fewer Amazon stocks if you're going to be investing in a venture fund abroad.
Thanks, Kamal.
Nidhi, do you have any comment on if you see that legislation changing?
No, there's no change, because I recently was involved in a lot of those transitions, which I was doing for myself. So it remains as $250,000 that you could invest as an Indian outside of the country.
Thanks, Nidhi.
Okay. So there's another question here about how much money should you have if you want to be an angel investor? What's sort of the minimum investment? So you can either be an angel investor who's just doing it for fun, and you just write a couple of checks because you want to have fun. And if you're doing that, then many companies, the minimum for most companies to get in is typically either $5,000 or $10,000. So if you started off and you had something on the order of $10,000 or $20,000 you wanted to invest, you could just effectively buy a couple of lottery tickets. And honestly, if you're doing only 1 or 2 angel investments, you're buying lottery tickets. If you want to systematically invest to more predictably make money, well, you've heard that the magic number is somewhere between 50, 100 companies, something like that. So then you're talking about making sort of 50 investments of $10,000 each. So you're talking about $500,000 as a sort of minimum amount to invest. So it's only 5,000 per, but you want to do a whole bunch of 5,000 or 10,000 per, but you want to do a whole bunch of investments. Certainly a fund. I mean, I know our own fund, the minimum investment is $100,000. It's actually $25,000 if you work as an advisor, join our advisor group so you can support the companies. So certainly if you're an advisor with us, that $25,000 is a much better way to get a diversified pool of investments together very quickly. Now, our fund, you need to be an accredited investor in your local country to get in. But really, look, if you're going to pursue this as a investment strategy, then you're probably going to find a couple of funds who are massively diversified to start off with, and that will get you started off. Or you have a larger amount and you can start to systematically do 10 deals a year within your own portfolio and just invest 100,000 a year to slowly over time build up a diversified portfolio. But it's really different amounts of money, small amounts of money, give it to someone else, get instant diversification, or just do a couple of deals. You're buying lottery tickets, have fun, enjoy it. And expect to lose all the money, but you shouldn't mind because it's a lottery ticket. You should expect to lose all the money if it's a lottery ticket. And if you win, hallelujah. But if you have larger amounts of money, if you're a family office, et cetera, then you can start to build up a systematic strategy of doing your own direct investing. Perfect. Are there any other questions? I see a message has come in here. Thank you very much, Teresa, for attending. She said really enjoying today's session. And Nidhi, thanks for the note there. If you do want to find out more about our fund particularly, our strategy, if it's something which may be of interest to you and you are an accredited investor, and the rules vary by country, it depends where you are. Happy to share the rules if anyone wants to know. But anyone who's interested can hear a pitch directly for our fund at loyal.vc/askUsAnything. If you're someone who qualifies and who's able to attend that session, we run those each week.
I wanted to make a comment if
Please.
I may, if possible. So just to share an experience, and this is personal experience, I had been traveling in the last few months, and whoever I've been meeting in India or even in the US, I think a lot of, I would say, institutions now which are involved in asset management are looking at options outside of the country as well. So they want more and more diversification, especially even in a country like India. Firms are looking for diversification within their portfolio. So I think it's something which is now increasingly becoming important as a trend, is what I could gather.
Yeah, no, I think so. And by the way, people like you, Nidhi, will know the Indian market far better than I do. But the Indian market, from the point of view of our few portfolio companies who are based in India, really seems to have been on a roll. We've got some excellent companies coming out of India, and that's exactly what happened. Is the U.S. Silicon Valley tech companies were on a massive roll. Prices started to go up. It was and it's sort of. You could see what happened. It's like prices went up. It was on a massive roll, and then it started to come down again. And that's one of my worries about being too exposed to any one market like in India, is I think it has been a very good period for the Indian market. It may continue to be a good period, but the question is how long. Things that go up do go down. Things move in cycles. And yeah, it's been a great time to invest in India. Is it a great time over the next 5 years? Don't know. We'll have some investments in India. We'll find out. But that diversification just makes so much sense. Thank you very much, everyone, for attending. Hope you enjoyed the talk. Yeah, very happy to share or support you. Like I said, if you want to find out more about our fund, loyal.vc/ask-us-anything, you can hear about our fund specifically. But I hope that just sharing our experience has been useful for you and has given you a couple of things to think about as you do your own direct investing, either in companies or if you're considering funds. I hope this has been useful for you. Thanks very much.